The road to buying a home is riddled with misinformation that can cost you big time. Here are some simple truths that can help you avoid missteps, save you money and stress, and get you to your ultimate goal of home ownership. Hi, this is Ed Villeda, local realtor, here to talk to you about the loan pre-approval process, to give you advice, debunk some myths, and clarify how the loan approval works, what's required, and some workarounds when you're not an ideal borrower. Think you need perfect credit to buy a home? Think again. Yes, it is easy to get a loan with good credit because you have proven yourself to lenders that they can trust you with their money. But did you know there are ways for a good mortgage broker to help you build credit in other ways? Yes, you are right. It is more complicated. But a good lender can help you build credit with on-time payments of 3 different bills that are not normally required to be reported to the credit bureaus, such as rental history and utility bills. In addition, high credit scores are used to give you the best rate, but the minimum credit required varies depending on the type of loan that you seek. For example, the minimum credit required for an FHA loan is 580, and the minimum required for a conventional loan is 620. But let's say you don't qualify for FHA or conventional loan because your credit score is lower than 580. Do you have any options? Believe it or not, the answer is yes. There are loans called non-QM or non-qualified mortgages. In these type of mortgages, borrowers can get a loan with credits in the low 500. Obviously, you need to keep in mind that the lower the credit score, the interest rate will tend to be higher, and the down payment requirements will probably be higher as well. Think you need 20% down to buy a home? Not even close. Down payment misconceptions. Different types of loans have different types of down payment requirements. FHA loans require a minimum of 3.5% down payment. For conventional loans, they tend to be 5, 10, or 20% down payments. But there are some programs that require only 3% down for a conventional loan. If you are a veteran, you can buy with a VA loan, and that loan requirement is 0 down payment. Yes, that is correct. It is an added benefit for serving our country. Thank you for your service. If you buy in a rural area of Connecticut, you can buy with an USDA loan, which also requires a 0% down payment. And believe it or not, 55% of the 169 cities and towns in Connecticut are considered rural. See this map here, where everything that is not red is considered a rural area. Additionally, if you buy a foreclosed home by HUD, you could buy it with $100 down. That's right, only $100. Furthermore, if the down payment is an issue, there are some programs for down payment assistance that can help you with the down payment and closing costs. For instance, SHAFA has a program for down payment assistance that gives you up to $20,000 with only a 1% interest rate on that money. And there is the time to own program that can give you either $25,000 or $50,000 to buy an owner-occupied home. The amount will really depend on where you buy. And there are some requirements. But bottom line is, if you don't have all the down payment that you need, there are ways to get it. You just have to look for it. Just 2 weeks ago, I got 2 different buyers under contract. One is getting $45,000 in assistance, $20,000 from SHAFA, and $25,000 from the time to own. My second buyer is getting $70,000, $20,000 from CFHA, and $50,000 from the time to own program. Obviously, they are buying a home that as an owner occupied. But if you need assistance, there are programs out there that will help you find the down payment. Think you need to make a lot of money to qualify for a loan? Not really. Income requirements clarified. Income is really a big determinant of how much you get approved for. But depending on the price range that you're looking for, you may yet get approved, as the amount approved tends to be a portion of the reported income. For instance, if you're buying with an FHA loan, the debt to income threshold is higher. Most times, you're allowed to go up to 55% of the debt to income ratio. If you are going with a conventional, however, they usually want to keep that under 45% of the debt to income ratio. This is a conversation to be had with your mortgage broker, because if you're carrying credit card, debt or a car payment, they may ask you to pay things down so that the ratio works better and get qualified for a higher amount. There are also legal tricks that lenders are allowed to use to qualify for more if that is what you wish. Obviously, proceed with caution. For instance, a car payment is not counted if you only have 10 payments or less left on the loan. This is for cars that you are buying and not for leases. As with a lease, you'll obviously need to get another car when the lease ends. You should also know that if you are a W-2 employee, your loan is pretty straightforward and your income is very easy to verify. For a 1099 people, us self-employed people have a harder time getting approved for a loan because the income is not steady, as there is no weekly or bi-weekly paychecks. Most lenders will require 2 years of taxes, and they tend to be an average of the income, as they won't base your income only on the last year's income, as it could provide an accurate picture of your financial situation. You got pre-approved, so all you have to do is find a home and close, right? Stop. Pre-approval versus final approval. When you get a letter from your lender, it tells you that you've been pre-approved. That pre is a very important word because it does not mean final approval. Final approval is only obtained after you found a home, you apply for a loan, and the rate has been locked, and the lender has double and triple checked your income, assets, work history, taxes, etc. Bottom line is, working with a local lender is very important. Yes, I know everybody has a cousin that did everything online and everything worked out with a national lender, but trust me, there are a lot of nightmare stories too. A local lender that you know and trust will save you a lot of headaches. In my experience, national lenders do very little research up front and will issue a pre-approval in minutes, and that pre-approval letter is basically worth nothing. If your lender gives you a letter without verifying your income, assets, credit, etc., it is not worth much. You should keep in mind that things can happen between the time you get pre-approved and the time you close on a loan. If there are significant changes to your financial situation, you can have the best lender in the world, but the numbers don't work anymore. You may be out of luck. Keep an eye on your financial situation and make no significant changes, and you should be ready to get the keys to your dream home in no time. You make good money, so you have nothing to worry about. Wrong. Assessment of other debts. Your lender will give strong consideration to other debts you carry when determining whether to approve you for a loan or not. This is why it is very important to have a low debt-to-income ratio. One thing to consider here is, and I will give you permission to be selfish, do not co-sign on anything for friends and relatives. They can be great people, but at best, they will make your debt-to-income ratio high. And at worst, they will default and ruin your credit and probably ruin the relationship. Best to just say no. Here's some advice on how to keep debt-to-income ratio low. Pay high debts with balances. Lenders do not like to see your available credit used up to its max. Call your credit cards and try to get them to lower your interest rate. That way, more of your payment goes to principal and not just interest. If you find that you spend more when you pay with a credit card, then leave the credit card at home. Sometimes you just have to stop. If you are looking to do a larger than $100 purchase, implement a 24-hour rule. That should give you time to think things over before making an impulse purchase. If you still have high debt-to-income ratio, take on a side hustle that you enjoy. You can make some money while doing something you like. Warning, don't settle for the first lender you talk to. Shop around for lenders. You should know that some lenders specialize in different types of loans, and they all have different personalities and work differently. Some may want you to do everything electronically, and others will want you to meet with them and do things in person. You should find someone that matches your personality and you feel comfortable with. The rates and closing costs should honestly be similar, but it doesn't hurt to compare. A good source for lender referrals are friends and relatives that have bought recently, but the best source is your realtor. But you do need to do your research. Look at the reviews online and have a conversation with them. Do they answer their phones? How available are they? The lending part of the home purchase process is extremely important. You should interview at least 2 lenders before deciding on who you will work with. Now that you understand the pre-approval process and what it takes to get to the closing table, I hope your mind is at ease on what it will require from you. Again, your credit doesn't have to be perfect. Down payment doesn't need to be 20%. It depends on the type of loan that best fits your financial situation. And even if you don't have enough for a down payment, there are resources available to you. A loan pre-approval doesn't mean that your loan is guaranteed. It means that you are very likely to be approved, but still need to go through the final approval process. You need to be mindful of other debts that can present a less than ideal financial picture to a lender, and interview at least 2 mortgage brokers to see who best fits your personality and can make the loan process a breeze for you. If you find this information useful, please like, comment, share, and subscribe to my channel. Thank you.